welcome to TheoTrade. This is Don Kaufman. First, a quick announcement, and then we shall get to the weekend video update. We're going to be doing a session this coming Tuesday, and that Tuesday, it is January 16th, 8 p.m. Eastern Time, 7 p.m. Central. The session is going to be talking extensively about how to use option strategies in today's markets. Now, in this upcoming video here, I'm going to be talking about a major transition that is playing out in today's markets. And really, this January 16th session is going to be a major follow-up upon that. We're going to talk about the right strategy and really taking the right logic and approach, whether you're an intraday trader, a swing trader, a longer-term investor. You will know the right time frames to use and the appropriate risk exposure, especially in a time that we have the markets exploding to the upside. There are going to be some phenomenal opportunities out there. We're also going to discover how you can kind of make some small tweaks, small adjustments to your current trading regimen that can really produce phenomenal results. And I'm going to couple that with how to understand the correct trade logic. And that's something I talk about all the time, which is a much more quantitative or mathematical approach to learning how to exploit, marketplaces, to a number of degrees over there. And really, what are some of the next steps you can take? Whether, again, you're trading or investing, this is going to be really actionable information that we're going to be looking at. Again, how to use option strategies in today's markets. If you want to register, follow this link, TheoTrade.com/strategy. Again, that's TheoTrade.com/strategy. Now, let's get to this weekend's update. All right, welcome to TheoTrade. This is Don Kaufman here doing the weekend update for January 13th, 2018. Well, we're doing a little bit of on-camera work here, as many of you have requested that. I ultimately feel like I'm coming out of hiding just a little bit. With that, there are going to be three predominant factors that I believe have not only changed, but we're in the midst of a major transition inside of the marketplace. Well, we're going to take a look, again, very detailed at these three factors. Let me just list them off here really quick. Number one, this week we've actually seen the skew absolutely collapse inside of the SPX. And for those of you that are aware, the skew, it's the out-of-the-money puts, and it's really the premium in the out-of-the-money puts versus the out-of-the-money calls. And when I say the skew collapsed, it's really kind of changed the entire structure and environment of not only the SPX, but we're also seeing those skew differentials in many of the major equities out there. And ultimately, that's going to lead to a huge opportunity for those of you that are looking for a little bit of a long shot trade. Again, I'll show you that here in just a moment. Number two factor that we want to look at happens to be none other than the VIX itself. Now, I don't talk a whole lot about the VIX. I have no love for the VIX, but we're seeing a market right now explode higher. And yet the VIX is also increasing. Now, we've seen this regularly, since about November. However, alongside with these other factors that are changing, this I believe to be a major transition. And again, we'll show you that. Now, factor number three here that I really think stands out. Options volume has exploded in the first 2 weeks of trading here. Now, why is that unique? Well, first of all, the options volume yesterday, which happened to be Friday's trading session, was like 27 million contracts, which is almost unheard of. You know, typically when you see something like 27 million contracts of options trade, that's usually a huge, wild down day. Yet we're now seeing it to the upside. And again, I'm going to show you here momentarily that ultimately skew, coupled with this transition, if you will, to extraordinary options volume alongside of volatility increasing with market going up, is quite definitively a transition in the marketplaces. Let's get right to it here on this weekend's update. All right, let's get started here on this weekend's update with looking specifically at the SPX. What can you say other than absolute shock and awe to the upside? Once again, the SPX exceeds its expected move, and it did it quite readily. So the expected move last week, and for those of you that do tune into the weekend updates here, you'll know that I not only draw the expected move on a week-to-week basis, but I also discuss it kind of the week thereafter. The expected move on the week, and this again, we're going back now to January 6, 2018. You see the expected move is right around $22. And I specifically said, buy it. Be a buyer of premium ultimately into that. Now, we're in the midst of a very unique transition, and I've been talking about this transition where on a short duration basis, I think there's some great opportunities to be a net buyer of premium. But the transition that I'm referencing here is that we're going to see volatility start to really expand, which we did this week. We're going to see this volatility expand. We're going to transition back into sellers, net sellers of premium. Nevertheless, you could see that last week we had a $22 expected move. And people, if you bought premium, you did quite spectacular as the markets exploded to the upside. And again, the irony, and I'll talk about this in a moment, is the VIX went up with the SPX going up. Nevertheless, I also want to show you this, and here is part of this happens to be as the market started to appreciate to the upside. Again, look back at last week's expected move. We were trading on about a 7% implied volatility. Now we're fast forwarding to what's the implied volatility for the coming week? Well, the coming week is interesting, and I'll tell you why it's so interesting. First of all, there is no Monday. It's Martin Luther King. Markets are closed, right? So we only have Tuesday, Wednesday, Thursday, Friday. It's a 4-day week. Again, another 3-day weekend. I will take what the defense gives me. So we have an expiration on Tuesday, an expiration on Wednesday, an expiration on Friday morning, and an expiration on Friday afternoon. That, people, tells us a whole heck of a lot about implied volatility. There's no real give and take in there, right? It's telling us exactly what the moves are almost every single day of the week. The only day we don't have an expiration is Thursday, but that's okay. We have an expiration on Friday morning. Now, the reason I'm bringing this up is, again, last week the IV was about 7%. This week, it's expanding out to 8.84%, but we only have 4 trading days. So this is a drastic increase. And you're like, oh, come on. Last week we had a $22 expected move. Yeah, this week we have a $26 expected move, almost $27, and yet it's only 4 trading sessions. So there is a big differential in there. So again, I am not going to be proclaiming that we should be net buyers of premium this next week. I want to make that abundantly clear. I'm not going to be proclaiming to be a net buyer of premium for the short duration for this coming week because the implied volatility, it picked up. Now, let's get to what I talked about are these 3 kind of key factors in the marketplace, right? And let's take a look at these 3 factors that really have changed. And again, I believe that we're in the midst of a very substantial transition. And before I get to this, I want to clarify, when I say a transition, it has a lot to do with whether you're going to be a premium buyer or a premium seller. But effectively, when I'm talking about a transition, is from a marketplace that has been incredibly efficient to a marketplace that is consequently not so efficient. And the lack of efficiency, when I talk about lack of efficiency, what I'm really getting into, volatility. It's going to get wild out there, and you're starting to see this. And when I say that volatility is going to get wild, that, people, is wild. Exceeding expected moves 2 weeks in a row, you're like, oh, okay. Listen, I've seen that movie before as well. But have you seen this to the upside with the 3 factors that I'm about to kind of distinguish here? So let's get to a couple of those factors. Factor number 1, this is what we term skew. Skew is only calculated at the end of the day. So I've got a style here. All the style happens to be is just taking a look at what I call skew line. It's just a line chart because they calculate it at the end of the day. Skew recently has absolutely collapsed. Now, let me get to the real details because, looking at it, you're like, okay, skew has collapsed. That sounds really exciting. Okay, what is the skew? I'll bring this up to you in the SPX, but it's really collapsed in the entire marketplace. If you look at options about 30 days out, open up about a ton of strikes over here, about 40 strikes, right? Then flip one of an information layout to what's called implied volatility. Now, what I want you to see is the out of the money implied volatility. The out of the money implied volatility here is about 10%. Okay. And you go to the out of the money implied volatility on the calls, it's about 7.3%. Now, if you looked just a few weeks back, okay, the out of the money puts were jacked in premium versus the out of the money calls. To me, this is incredibly advantageous. The puts on a relative basis are inexpensive versus what they were just a few weeks ago. Now, I don't want to say that the puts are really dirt cheap, but they're cheap on a relative basis versus a few weeks ago. So for those of you, if you're looking for like a long shot kind of strategy, oh boy, there are going to be opportunities out there because the skew is flattening out, and it really has flattened out a lot. You know, I started looking at like individual stocks in here. For those of you, you know, if you want to look at a couple of individual stocks, I started looking like crazy stuff like Amazon. Amazon hit, $1,300. It's an unstoppable force to the upside. But what's really, really interesting is although the skew kind of flattened out in the index products, check this out, because this is the stuff that people just don't catch, right? And look at the out of the money puts here. All right, they're at like a 30 volatility, 30 volatility, 30 volatility, 30 volatility, 30 volatility. Okay, and those are even at the monies. Then you start taking a look at the out of the money calls. It's the exact same as the out of the money puts. Okay, the skew is completely and utterly flat. That means at this point in time, they're not pricing risk to the downside in a product like Amazon, and they're pricing a lot less risk to the downside in products, okay, like the S&Ps. That makes it incredibly advantageous for those of us if you're thinking like, hey, this market might continue to the upside, because this is what this amounts to. So go back to the spiders now. You might think to yourself like, this market, it's just going to keep going, Don. This is not so much about direction. This is about affording yourself opportunity, right? So when I look at something like the spiders, let's say for argument's sake, let's just say the market is going to explode to the upside. It's going to continue to explode to the upside. Well, what you want to do, okay, when the skew is flat like this, in the short duration, you can go just 6 days out and check out the deltas here. You can buy in the money calls, okay, for the short duration. Why? Why would you want in the money calls? Because it gives you a lot of bang for your buck, but it limits the risk. So just for the next 6 days, like if you say, hey, this week the markets are going to continue to explode to the upside, you buy some in the money calls, 85 kind of 90 delta stuff, right? And you ride the markets. Now, why aren't I going further than 6 days? Because if I am wrong and this market implodes, what do you want to do? People are like, I want to go out there and I want to buy me a leap. Oh yeah, you want to put what? You want to put like 20, 30 bucks at risk in a marketplace that could implode at any point. Listen, we're exploding. There's only, two things you could do. You can explode to the upside or implode to the downside. And I'm telling you, cover your risk out there. Mitigate your risk by, if you think we're going to go to the upside big, you don't go out there and buy the spiders. Don't even buy the S&P futures. Just use in the money calls. They're giving you like an 88 delta here for $5, bucks. What's the worst that can possibly happen? The market tanks. Let's say there's a 6% decline in a week. Oh, but still my heart, you're going to lose $5. But at the same time, here's the cool part, that at the same time, because the skew has flattened out and the skew is mellowed out, it's going to give us the opportunity to build strategies way out into the future that will give us huge volatility exposure, meaning that the volatility is cheap on a relative basis. And that's something I'm going to be talking about this coming week here on TheoTrade. So again, factor number one in this transition is the skew has drastically changed. Factor number two, okay? Now, when I say factor number two over here, normally I don't look that often at the VIX, but this is pretty nice move to the upside. Like if people are not seeing this, yeah, volatility is coming up with the market going up. Now, hey, listen to me. This ain't the first time. This ain't my first rodeo here. It's not the first time I've seen this. We've seen a lot of this actually starting kind of in November, where the VIX was going up with the market going up and the VIX going up with the market going up. Listen, the VIX could get collapsed right back down, but it's kind of a weird week where the VIX is going up ultimately, and volatility is expanding with the market going up. In fact, I just showed you that in the SPX. Okay, as I said, the expected move this coming week is $26. Now, I wouldn't be buying premium into that because $26 in 4 days, well, could it happen? Absolutely. Okay, but I think we're in this transition from being premium buying to premium selling. Now, the skew, okay, coupled with the VIX, now we're starting to get interesting. Now, here's one of the last pieces of this puzzle. And this one, okay, if you're not familiar with this, and it's shockingly white, it's just an email that I get. It's the Option Clearing Corp. Okay, OCC contract volume. This, listen, if you're not on this email, don't worry about it. But I look, I'm a total quantitative geek, and I look at this stuff day in and day out. And the option, total contract volume of 27 million, that really stands out. That's scary, scary large, okay? And here's the really crazy part about it. I'll come back to that in just a second. When you look at option contract size, I always compare it to S&P futures. And the reason is when there's big size trading, okay, in option contracts in general, most of the time they're mitigating risk using the S&P futures. But here's the crazy thing. The S&P futures, the volume out there since the start of the year, how do I say this eloquently? It is terrible. The volume is so ridiculously low. Like the S&P futures, I mean, these things aren't even doing like 1.3 million contracts. Again, on Thursday, it was lucky to do like 1 million contracts. That is not indicative of like heavy, risk out there. That's indicative of nobody cares. But at the same time, 27 million option contracts, people, something's got to give. Something has got to give. You're getting a rising VIX, a flattening skew, 27 million option contracts. Just in comparison, check this out. That's January of 2017. It's a year ago. We weren't even averaging 17 million contracts. Okay. All of a sudden, and by the way, almost all of last year, all of 2017, we were averaging right around 17 million contracts in a day. Because again, not everybody speaks geek and looks at this stuff constantly. The January 18 average thus far has been 21 million contracts. So all of a sudden, we're talking about like, a 20, 30, even 40% increase in the option volume trading over there is substantial, especially when it is not being coupled. It's not being coupled with big volume coming from these S&P futures. Again, behold, there is a tremendous amount of transition going on in this market. And I know that all that people see is like, it's you're getting to this stage. We're beyond fear of missing out. Okay. If you want to ride this thing to the upside, I just showed you what to do. You hop on the spiders, okay, or hop in the Qs, buy in the money calls, really, really short duration. Because when this does crack, okay, with a flattened skew, when this thing cracks to the downside, people listen, there's huge possibility of opportunity to the upside. I am not going to disparage if you're a bull right now. Okay, I'm not going to rip on you for being bullish. Clearly, people are getting to this like fever pitch kind of stage, and I think that that's why the option volume is ripping right now. But if you're riding this thing to the upside, okay, this is like keep your hands and feet in the vehicle at all times. If you put a little too much risk out there, you are going to lose, okay, a lot. At the same time, if you want to ride this marketplace to the upside, awesome. But at the exact same time, okay, we're going to be looking for what I would term long shot, 3 sigma moves to the downside. And what that effectively means is if you look at a distribution curve like this, we're going to be looking for tail risk kind of stuff. A marketplace that's capable of making a wild move to the downside because, hey, the only way we're coming out of this rally is with shock and awe. Thanks, everybody, for joining us here for the weekend update. Have a wonderful weekend. Bye-bye.